Let's learn something really quick.
If you got the time, absolutely. And you got the discipline, there's no question about it.
I love that. Yeah, that's a great practice to put into your everyday life, you guys.
You generally regret the things you don't do, not the things you did do. Let me say it that way.
Mic drop. This was just awesome. I love meeting my guests in person, and it's a whole nother animal, and the energy is just electric. You guys, this is your host, Deanna Radulescu with Label Free Podcast. To live your best life, you must live label free. What is good, everyone? This is your host, Deanna Radulescu with Label Free Podcast. To live your best life, you must live label free. As always, bring incredible guests from all over the world, so sit back, relax, and tune in. My next guest is a 40-plus year professional investment manager, advisor, RIA, IAR, whose current adventure is coaching both individuals and other advisors in creating income independence for themselves and their clients. He's also an author of his second book, promoting retirement money secrets. Please welcome Steve Selengut. Steve, welcome.
Well, thank you, Deanna. I'm happy to be here with you.
I'm excited to have you here, Steve. Now, like I said before we started the recording, I think that there is the idea or labels or misconception around money for a lot of people and how they can manage it, become wealthy, and really be empowered around how they invest their money. So I want to get into a little bit about you as now a coach in the space and your long career of successfully managing, being an advisor in this industry.
Well, being coach is certainly different than running hundreds of portfolios by yourself every day. It's actually more interesting because you get the opportunity to see what other people have done and what other advisors have done for them or with them or through them, whatever you want to say. And I've sort of developed a 4 pillars of risk minimization when I look at portfolios. In doing that, I can tell if a portfolio has been set up speculatively or more into quality, whether it's been over concentrated in certain places, try to make a big hit, or if it's been diversified properly. I say properly because as a student of it and a teacher of it, I've taken the route towards wealth and towards other people's wealth is much more conservative than I think the hype of the stock market allows many people to do, because they get all excited about this one that's going up. Oh my God, it's going up so high, and you see all the people throwing things up in the air on Wall Street and ringing the bell and all this excitement when it's really not. It's really not that big an adventure. It's all pretty basic, and it all boils down to running, in my mind anyway, and how I've done it, of running your investment portfolio pretty much the same way you would run or manage a department store.
Okay, that's interesting.
A store that has every product you can imagine from all over the world. And you own, in my case, I own funds professionally managed funds that contain things from every possible sector and every possible country that's involved in markets and all that. And I treat them, once I vet them for these 4 principles that I'm going to talk about.
Okay.
Once I vet them and I know they all meet my quality, diversification, and income requirements, I can comfortably trade in and out of all of them without having to rethink it each time. Each time I get my dividend income at the end of the month, I don't have to go study and look for opportunities. I can simply go to what I've already got and add to or sell, that type of thing.
Yeah.
If you run your investment portfolio with the same management skills, thinking of everything you do as merchandise on your shelf, when somebody wants to pay you, you mark up. You don't say, no, it's going up tomorrow. Right. Say, here, you can have it. I'll take my profit and I'll put something back on my shelves.
Interesting.
And that's the way I look at it.
So you're saying how the mix of like conservative and then some risky investments as well?
Well, let's say you own an individual stock, which is riskier than owning a bond of the same company.
Okay.
Because when something goes out of business, shareholders get nothing. Bondholders may get something if there's anything there.
So before we get into, let's explain to the audience. So if we're going to like kind of educate them a little bit so that they'd want to purchase your book and empower themselves or reach out to you to coach them, what's the difference between a stock and a bond?
A stock is an ownership interest.
Right?
You own part of the company.
Yeah.
In most companies, you don't get a whole lot for that. These days, most people are in it for, to watch the value go up, and they're not really interested in participating in management or taking their profits when they're available. But they do have an ownership interest. And I always used to buy only stocks that paid a dividend, because that at least showed me that the other owners and the managers of the company had enough respect for the owners that they gave them something for the use of their money.
Right.
So stocks are actually ownership. If the thing goes out of business, just like your brother-in-law's pizza party, if you give him 10 grand, you hope he's going to succeed. If he doesn't, you lose everything, baby.
Yeah.
Now, and then there's bonds. Same companies. They use bonds to borrow money from the public or from anybody else. And it's the same with the pizza parlor.
Okay.
If you loaned your brother-in-law some money and said, this is a debt and you will repay me regardless of how the pizza parlor does,
Right.
it's likely that because he's your brother-in-law, he's going to actually pay you back.
Sure.
So there's a chance you're going to get money back, even if the pizza parlor fails.
So is the bonds got to be more expensive then?
Well, the prices are a matter of demand, supply and demand. Stocks are supply and demand. Bonds have a face value.
Okay.
And if you're borrowing $10,000, if the company's borrowing 10,000, you get a piece of paper. Not really. You get a data somewhere that says they owe you 10 grand, and then they'll pay it. Now, the value of that bond is going to go up and down for, let's say, the 30 years of the period. But the price being paid is always the same. So it makes it a very secure, sound investment.
Okay.
Because you're going to get this interest every year.
Right.
Whereas with a stock, you don't know if you're going to get depends if they make money. So that's the big distinction. So what I look for, and I do this with funds that own literally hundreds of different companies, or hundreds of different bonds, or hundreds of different mortgages, or pieces of real estate, and all, like I said, in all different sectors of the world economy.
Yeah.
And, so that's what I look to own. And I vet them by determining their quality. And that'll be things like, how long have they been in business? Are they profitable? How many irons do they have in the fire? Are they, is their only product buggy whips? And if we get automobiles, they aren't useful anymore, or do they have a bunch of different things going on? So these are quality things. When I look at a stock for quality, I also look at the volatility of the price, because I'm interested in generating income, not just from the dividends I receive, but also from profits that I'm going to take if it goes up. And I have requirements for that too. So that's quality. The other one, the next pillar of keeping things less risky when you're an investor, is to make sure you diversify.
Right.
You don't want to have all your money in any one security. You don't want to have all your money in any one sector of the market, or even any one country. This is a global economy we live in. So we do this with these managed funds that I'm talking about. And I literally own hundreds of them. And the people who I coach, I give them access to the ones that I've vetted, that I use myself. And then they can do their own due diligence on those to see which ones they want to have in their own portfolios.
Fascinating.
But so that's diversification. You can't ever be in a position where you have, well, let's put it this way. In my portfolios, which are okay, I don't have as much as 3% in any one security.
Sure.
Most of them are less than 1.5%.
Wow.
And I have over 200 different securities. A lot of people most people don't have to go that far, but I like it that way.
So basically you're doing pretty well with your investments then.
Well, I've been investing since I was 25. Yeah, I've done rather well.
Well, that brings up a question. So you started investing at 25 till now, however many years later, has the marketplace changed in terms of how you should invest?
How you should invest? For me, it has. I
Yep.
always focus. This will be the 55th year.
Wow.
I started
You look
investing
great.
pretty much on my 25th birthday. So I've always focused on income and quality because I was fortunate enough to get a portfolio to work with when I was that age. That was
Yeah.
totally quality company. So I grew up that way. Everything I owned paid a dividend. It was all stocks.
Yeah.
And then I learned about the other side. I learned when I got a job and I was starting to think about taxes, as my job developed,
Yeah.
I learned about tax-free securities, tax-free bonds, and I started to put an income portion in my portfolio as well. And then I grew up as an investor and realized that stocks behave differently than their equities and income focused securities. They don't go the same way all the time.
Mm.
In fact, they rarely go the same way. Like right now, for example, equities are up and the income sector is up over last year, but still way below where it was 5 years ago, where the stock market is almost at an all-time high forever. So I learned these differences. I learned that there's a market cycle that you can't fight it. You have to take advantage of it.
Well, that brings up a question, and this might be kind of corny to talk about, but I watched that movie over the whole GameStop scenario where people were taking advantage of that and buying into that and that whole, I mean, I don't remember all the details, but that was quite interesting. And I remember when all the hype was coming out about that a couple of years ago and what was happening. And what are your thoughts on that? I mean, a lot of the young people were taking advantage of the opportunity.
Well, they're taking advantage of the opportunity, but not many of them actually took total advantage and took the profits that they could have had.
Yeah.
I don't do that kind of individual security trading
Okay.
myself, but it's very speculative. It wouldn't fit within my quality requirements. It
Right.
didn't pay a dividend,
Right.
that's one of the things. So I'm looking. See, I guess I was always more conservative.
Sure.
I didn't necessarily want to go out and hit home runs. I wanted to get a lot of singles. I didn't want to make any errors, that type of thing. So I was very safe and conservative, and that's led over to the way I managed other people's money the same way. I used to tell my clients that I will never, ever put you in anything that I don't own myself. Right now, if I don't own it, I'm not buying it for you. And, so that's the way
I agree with integrity then.
tried. Yeah. I mean, I think it's essential, particularly when it's other people's money. You know how people are about money. My God.
Well, for sure. But I can't imagine that all investment advisors operate with integrity.
I think they do.
Yeah. Okay.
Okay. I think the way the financial community is set up, they say they're acting like fiduciaries, but who's making the rules of what a fiduciary is?
Yeah.
If in my mind, particularly if you're talking about people in my generation, most of whom are retired, right? Like me, I'm not retired, but most of them are. What's important to me is the income I'm generating from my securities and the safety of them. Not the safety. I know they're going to go up and down in price.
Yeah.
But I want to be sure that they're not going out of business.
Right.
And so I generate and coach people into portfolios that are generating in these days almost 10%. Whereas if you were to look at your portfolio, or any people listening right now would actually look at the income, don't think about returns or total return or market value, just the income that it's being generated. Particularly if you happen to have model portfolios in your in your investments, your income is going to be 3% or less.
Wow.
I'll give a free book to anybody who sends me a portfolio managed by someone else that's paying more than 4%.
Wow. Listen. So you are an anomaly then.
That's how sure I am of
Okay.
that relationship. Because, and this is why I say it's not the financial advisors that are doing this or misleading it. It's what the pressure is on them from
Mm.
their organization, their companies. The world of Wall Street gets paid on AUM, which is amount under management, and amount is measured by market value.
Mm.
So the type of portfolios that I use that generate income are trust vehicles.
Okay.
And as a pass-through trust, they're required to give their share owners 95% of every dollar of profit they make.
Wow.
So think about if that were Wall Street stocks, if that were Amazon giving its shareholders all that much for their money,
Wow.
think
Yeah.
think of how happy we'd all be.
Oh, for sure. Oh my
You know,
gosh.
but they wouldn't have grown like they did either.
Right.
So it's a double-edged sword. If you're going to focus on income, you've got to not focus on market value growth because there's no way a company that's paying you that much of its income is going to grow in market
Right.
value.
Right. Yeah.
It's going to keep
Makes sense.
right. So,
Yeah.
so that's the thing. My focus is on income. Wall Street's focus is on growing market value. Two different things.
Right.
You have to tell your financial advisor, I want you to get me more income. You're telling me that I'm going to have to spend 4% of my net asset value or my market value every year in retirement.
Mm.
And you're hoping I don't live more than 25 years
Right.
or that the market goes up more than 4% every year, which it doesn't. It
Mm.
may average more than 4%, but every year that doesn't happen.
Okay.
I want you to make me more than 4% in dividends. And then when you hear, well, we can't do that. I said, and then you give them this list that Steve just gave you.
There we go.
200 of these 240 securities that pay, and every one of them pays more than 6%.
Wow.
So, you just,
Yeah, this has got to be worth something then.
you have, excuse me?
That list that you have has got to be worth something then.
Well, I do charge for it.
I was gonna say because
I do,
but
but a whole set of all three of the different, there's three different types, basic types, tax-free, taxable income, and equity. But
okay.
all three of them come with a coaching session.
Oh, nice. Okay.
Okay. So I do give it to them for that.
Oh, very nice. And so so you will coach not only advisors but independent people as well?
I've coached maybe 100 independent people already.
Okay.
And I've coached two, maybe three advisors.
Oh, okay. So more independent people. Can you give us maybe like a success story of someone that you've coached independently and like what they came to you for and what the end result after them working with you?
They usually work with me about two or three sessions.
Okay.
And when they come in, I do this. We were starting to talk about the risk, the 4 pillars. So I check that in their portfolio. And I've had some 7-figure portfolios,
Right.
and that's plural 7 figures, just
Right.
not 8 figures, but 7. And I've had some come in with literally $1 million, $2 million, and maybe in only 3 securities as part of the portfolio, or more than $1 million in 1 security, or 5 or 6 million portfolio owns only 6 different or not bonds, but mutual funds or something like that. So diversification just awful. And so that's the type of thing I would point out to them. So I help them help them, first of all, decrease their exposure in those positions as quickly as the tax code would allow. Because a lot of people get into retirement, they have The problem is if they take their profits, they got to pay taxes.
Right. Right.
So, so if they were taking their profits all along, they wouldn't have that problem.
Mm.
So there's a lot of work to do to get them to realize that this, $2 million worth of Microsoft is only paying them 1%, and they want to retire. And if that $2 million instead was paying them 200,000 a year instead of $500 a year, that would happen. So you have to can show them, oh my God, yes, I can do that. You can still love Microsoft, but love it because you've made all this money, not because it looks good on your balance sheet. So those are the types of things, and those are really they do bring a smile to your face when you have a guy who said, okay, I've had people say, hey, it's changed my life. I mean, I can do what I want to do. I can go to the same place you go every year. I don't have to just get the pictures of you on vacation. I can be there with you.
Well, that's a good thing. That's a,
Really the satisfaction of the coaching.
yeah.
And it's you might say it's part of a mission or a vision
Sure.
that I see of someday one of the big companies will say, hey, instead of paying my people by how much market value they can have by throwing all their clients' money into NVIDIA for a year or two until it goes back to normal.
Yeah.
If I can I'm going to pay my employees based on how much money they make that their clients can spend.
Yeah.
That's, someday generations from now, somebody will accomplish that.
Mm.
But
I love it.
yeah, I've got to reach a couple more people before that.
But I love the mission, and obviously very educational. If I had $2 million invested in something, I'm only getting like 1% back, I would be pretty upset. Like I would expect to get more than that. Like that would not be okay for me personally.
Well, you might, but think about it. Most people in, are looking at it as, geez, this stock went up all this way and it's really there. And if it stays there, I'm wealthy and I can sell it when I retire and, then I can get some income. But what if it doesn't? They don't realize the danger they're in because of the hype around it.
Yeah.
And the other thing, and this is also in defense of the industry practitioners at the person to person level.
Sure.
If this guy comes to you and says, hey, you got this was before Microsoft, it was only up 50%, you got this huge profit in Microsoft. It's not paying you anything. Why don't we take that profit now and put it in these closed-end funds, these income things that Steve told me about?
Right.
And I'll be earning 10% a year. And then Microsoft doubles.
Right.
Or triples like it did. That guy can get sued.
Oh, wow.
Because he made the person sell it. So you almost never.
Oh, yeah.
All of the people who are listening to me will be nodding their head. You almost never have an investment advisor tell you should take a profit.
Okay.
You have to initiate it. If you initiate it,
yeah,
you'll probably get it in writing that you initiated it.
Right.
They'll sell it for you, but they're not going to put their neck out there like that.
Sure.
And I don't blame them.
Yeah. Let's talk about your book really quick before we start wrapping things up. Retirement Money Secrets. So this is your second book. Tell us a little bit about this book and what it does for the person that's going to purchase it or they get their hands on it.
It tells a story of my wife and I meeting another couple in Amsterdam before a Viking river cruise. And we talk about how they paid for the vacation and how I paid for the vacation.
Okay.
And it, raised their curiosity. And we started to talk exactly, the things I did. So it goes point by point through the mindset about a market cycle and a mindset on it generating income instead of market value and those pillars of risk that I talked about and all these other things that are the intricacies of investing in this new type of new to them type of security.
Sure.
So it's a story, and it's a conversation, and it's a lot like the conversations I have with coaching clients. So it's kind of it's kind of hit a chord with a lot of people that have called me, and they talk about the cranes,
Yeah.
and who they were and where they came from and all that stuff like that. So anyway, it's an interesting. I think it's particularly meaningful for people in their 50s or over. But the tenets, the conservative approach, the income focus will work just as well for busy people who are working and making significant money and need to know how to invest it for their future. You want to get to the position where you can say at some time, I make as much money from my investments right now in cash spending money that I do working here. If I'm not really enjoying this commute to New York,
Yeah.
I'm going to go out on my own and do my own thing.
Yeah.
And that's exactly what I did when I was like 30 something.
Oh, wow. Very cool.
I said I didn't want to commute to New York anymore. I was making more money than I was making at work. So I just,
There you go.
but that's the story that Retirement Money Secrets is all about. Getting you into the position to say, all right, I'm going to do that. I'm going to make enough money from my investments so that I'm in control of my future, not some other boss.
I love that. That's awesome. Where can people purchase the book and connect with you, Steve, if they're interested in learning more about hiring you as a coach or just wanting to support you in general?
The book is available everywhere, for Amazon. It's got Audible, only through Amazon, the Audible book, but the ebook and everything else is from any place you can shop. I have a website called theincomecoach.net, which after reading the book, people can go there to see what kind of coaching services I offer and how to get in touch with me.
Excellent. You guys, I'm going to put that link in the show notes, and also I'll grab the link from Amazon to go purchase the book. So if you connected with Steve's story today and want to learn more about your investment future, go ahead and click the link, both links, and perhaps schedule a coaching call with Steve. Steve, this is the part of the show where I like to ask for last words of wisdom or advice. What would you like to leave with us today?
I think it's almost like what we started with. If everyone who's listening would just take a moment and look at their portfolio to see the level of actual income it's producing.
Yeah.
And when they see what it is and then realize that they can be generating in today's environment safely, easily 8, 9, 10% instead.
Yeah.
And owning the same securities, because the securities that produce that much income contain the same stocks and bonds that you would buy individually or that you would have in mutual funds. So it's, so it's just that realization, that aha moment may set them in the right direction for their financial future.
That's like a game changer, I feel like.
People have said that.
Yeah, for sure.
Some of the book reviews say exactly that.
Amazing. Steve, thank you so much for sharing your expertise with us today. And I'm sure you've helped many people that will be listening to this around their investments and their financial future. So thank you very much for an eye-opening episode.
Well, thank you, Deanna, for the opportunity.
You're welcome. You guys, this is your host, Deanna Radulescu with Label Free Podcast. To live your best life, you must live label free. As always, don't forget to subscribe, follow, rate, review, comment, share, all those good things. And I'll be back soon with more dynamic guests.